Okay, Chapter 7, Cash and Receivables, Part 2, and we're going to look at accounts receivable. Now we have three types. We have accounts receivable, notes receivable will be in the next part, and we have other receivables, which are minor. So another thing to remember is we actually have the general ledger, which shows you the total for accounts receivable, but this is tied to the subsidiary ledger, which lists accounts by customer name to track customer payment history. It must tie to the general ledger. Accounting for uncollectible accounts. Bad debt expense is a selling expense caused by uncollectible accounts. Uncollectible accounts reflect a cost associated with selling goods and services. Companies that make sales on account expect the benefit of granting credit to customers outweighs the cost. So the benefit is we reach a wider range of customers. The disadvantage is they may not pay us. Now, we have two methods. One is the direct write-off and the allowance method. The direct write-off, you write off bad debt only when you figure out that you can't collect. That is not GAAP because it violates the matching principle. The allowance method is a method of accounting for bad debt in which bad debt expense is recorded in the same period as the sale. The allowance method adheres to the matching principle and is therefore required by GAAP. Now let's look at an example using the direct write-off method. So we made sales of $100,000 on 1/1/2021. The customer paid $90,000 a month later, and then the balance sat there, and in June of 2022, we determined that it could not be collected. So we write it off. And if you notice, we're going to debit expense and credit accounts receivable. If you notice, though, we booked the revenue in 2021, and now we're booking the expense in 2022. That violates the matching principle. Then in January of 2023, the client decides they want to do business with us again, so they pay us. So we first have to set up the accounts receivable again, back out the bad debt expense, and then show the payment of the receivable. Remember, regardless of whatever method you use, when a debt that has previously been written off is paid, you must reestablish the accounts receivable and then show the payment regardless of the method used. Again, this method violates GAAP. So now let's look at the allowance method. The allowance method is a method of accounting for bad debt in which bad debt expense is an estimate. The allowance method adheres to the matching principle and is therefore required by GAAP. Under the allowance method, a business uses an adjusting entry at the end of the period to record bad debt. So remember, the allowance method, when you book the expense, it is an estimate. Because the business does not know which customers will eventually not pay, it must estimate the amount of bad debt expense. And they do this based on industry averages and their own history. So we have a new account called bad debt expense. And we also set up what we call a contra account called allowance for uncollectibles. It is also an adjunct account. It must follow accounts receivable since accounts receivable has a debit balance. Allowance for uncollectibles, normal balance is a credit. So you would show accounts receivable less allowance for uncollectibles, you get net receivable. Now, sometimes when you look at financial statements, all they show is net receivable because they really don't want you to know how much they allow for uncollectibles. Shows the amount of receivables expected not to be collected. That's what the allowance for uncollectible accounts shows. When accounts receivable and allowance for uncollectibles is added together, that's how you get net realizable value. That's what you think you're going to get. Now, to estimate the amount of bad debt expense, a customer must use its past bad debt experience, and a lot of it has to do with what's going on in the economy. So, for instance, based on the last year and a half with COVID, the percentage probably would be pretty high. So, we have two methods, percentage of sale and aging of accounts receivable. We'll start with percentage of sale, also known as the income statement method. You take the estimated percentage of uncollectibles times the credit sales. Remember, it's credit sales, net credit sales, equals bad debt expense. So now let's look at an example. All right, we have a company that had total sales of 700,000. Of that amount, 200,000 was cash and 500,000 was credit. Customers paid us 400,000. We had a beginning balance in accounts receivable of 45,000, and the allowance account had a credit balance of 3,000, and in addition 1,400 was written off during the year. Now what I like to do is T accounts, and I like to start by setting up my balances. So what's the journal to book the sales? Accounts receivable, cash, sales revenue. That goes to our accounts receivable. What do the journal for the cash collections? That also is going to affect our accounts receivable account. What's the journal for the write-off of the bad debt? 1,400. That's going to affect our allowance and our accounts receivable account. When you use the allowance method, when there is a write-off, there is no effect on the income statement. Because why? Allowance for uncollectible and accounts receivable are both on the balance sheet. It hits the income statement when you estimate. So now we have our ending balances, and now let's do our actual estimate. So what is bad debt expense for 2022? Well, we're going to take our credit sales times our percentage. It tells us that's 7,500. This is the easy method. Then we're going to do the journal, which is bad debt expense, allowance for uncollectibles. You notice in this example, we're going to hit the income statement and the balance sheet when the estimate is made. What are the net accounts receivable? It's going to be 134,500. Remember that the allowance for uncollectible is a contra asset account, so the normal balance is a credit. And when you use the allowance method, when there is an actual write-off, there is no effect on the income statement. Now let's look at aging of receivables. Each receivable is grouped by date based on how long it's past due. Each age group is multiplied by its estimated bad debt percentage. Rule is, the further it's out there or the longer it's been outstanding, the higher chance you're not going to get your money. Estimated bad debt for each groups are totaled, added together, and that tells you what the ending balance should be in the allowance for uncollectible. Now let's take the same example, but use the aging of accounts receivable method. So we've done our journal entry for our sales, and we've written off our bad debt. Now we can do our estimate based on aging of accounts receivable. So here's what we have. Of the 143,600, 80,000 is 1 to 30 days. 34,000 is out there, a little more. 24,000 is more, and we have over 60 days of 5,600. If you notice, those percentages go up as the time goes by. So we take those times, our numbers, and we add them up, and it tells us the ending balance. And allowance for uncollectibles should be 6,880. So what is bad debt expense? Bad debt expense is what the amount we need to enter to get our balance up to 6,880. So we don't know our bad debt expense yet. So based on this, we need bad debt expense of 5,280 so that it will end up with a balance of 6,8880 in our allowance for uncollectible account. So here's our journal entry. And when we add those up, we get 6,880, which is what we estimated it should do based on our aging of receivables. Our net accounts receivable is 136,320. And remember that allowance for uncollectibles, again, is a contra asset account. So as a summary, if you do the direct write-off, you have no adjustment at the end of the period. You only write off when you actually have an entry, and it affects the income statement and the balance sheet. And when you get paid for something that's written off, you still have to reestablish it regardless of the method you use, and then record the payment. Now, when you use allowance method, you're going to have, when you do your estimate is when you book bad debt expense. But when you have a write-off, it's just an adjustment on two balance sheet accounts called the allowance for uncollectible and accounts receivable. And that ends this part.